Jason Wood, the VA Loan Guy, and today we're going through the VA Home Seminar. This is VA Home Buying 101, and this is designed to give you a great understanding of the basic principles of the VA loan so you can buy a home and know what's happening and what's going on, how this thing totally works. So what the agenda is today, we're going to talk about home loans. We're just going to give you the fundamentals of a home loan before we dive into the specifics of the VA home loan, which will come up next. Go over a few different sample scenarios as we go through the process here so you get some applied knowledge. And then we'll go over frequently asked questions, some unique characteristics and myths about the VA loan. And then we'll go over the purchase process. So here are the key ingredients, all right? So you got to arm yourself with information, develop a personalized plan, and then execute that plan, right? Something that we all learn while we're in the military is to really put together a plan and then execute it. So a little bit about me. I'm an Air Force veteran. I served from 99 to 2005. I started in lending actually in 2001. So I was still in the military when I got the opportunity to kind of dive into this mortgage thing. And I've built this brand in my business to the point where I have my own podcast. It's called the Armed and Ready Podcast. I'm the host of it. We talk with veterans, active duty people, a lot about their story, a lot about entrepreneurship. We do get into housing and stuff like that sometimes too. So if you're looking for a great podcast that's military focused, that's a great one for you. You can check me out on YouTube, VA Loan Guy on YouTube.com. You can find it there or on all of the podcast audio channels, Apple Podcasts and iHeartRadio and so forth. I'm a part owner in my mortgage company and a mortgage advisor. My mortgage company is American Mortgage Network. I am also a homeowner and the beneficiary of using a VA loan. I've used my VA loan multiple times. We'll talk about that a little bit too. So home loans 101. Here's the basic. What is a home loan? What are we talking about here when we're dealing with all this stuff? So there's three major characteristics of a mortgage. First is credit. Next is your income, and third is your assets. There's two major lending concepts as we talk about these three characteristics. Debt to income ratio. What debt to income ratio is, it is your debts as they report on your credit report. For example, your Visa payment that you might make an extra $20 or $40 a month payment on, the payment needed or required by you every month, let's say is $27, but you always pay $40. Well, when we do our math to determine what that debt is, we're going to use the minimum required payment that shows up on your credit report, not what you're actually paying. So if it's a $27 a month minimum payment, we're going to use that. But other things that come up on your credit report are things like student loans and auto loans, credit cards, mortgages, things like that. What is not going to show on your credit report and we don't use for this calculation are things like your renter's insurance or your car insurance or your Verizon cell phone bill, things of that nature, your cable bill, your satellite bill. Those don't show up on your credit report, so they're not part of this calculation. But what we do is we add up all those debts, and then we add the proposed new mortgage, including the property taxes, the insurance on the home, if it's in a homeowners association, the HOA fee as well, and then we divide that by your gross income. The gross income is the income number before taxes are taken out. So if you're active duty military, it's your rank pay, and then we also get to use some of the other bonus pays. So BAH is a big one. And the cool thing about the bonus pays is they're tax-free. So we actually are able to gross up that income by 25%. So it really helps with qualifying. So we can gross up that the BAH, your BAS, and sometimes it might have flight pay or hazard pay or some other things, CPay. All of that stuff we can include to help increase your income. But that comes up with a ratio. When we divide the debt into the income, it comes up with a ratio. Different loan programs have a different cap on this number. Loan to value ratio. So what does loan to value mean? Well, it's how much your mortgage balance is divided by your home's value. And that comes up with a ratio. So a lot of people have heard, you need 20% down to buy a home. Well, let's explain what 20% down means in loan to value. In loan to value, we would term that as an 80% loan to value, right? You're financing 80% of the loan. Easy math, on a $100,000 home, with this example, you would pay $80,000 in financing and $20,000 would be the down payment. 80% loan to value. All right, so credit. This is basically what the lenders use to predict the future or to kind of get a glimpse of what your performance is going to be like on paying back the mortgage. It's also an indicator, like I mentioned before, that we use as a tool to add together debts, but this is really a good predictor of how you're going to treat your mortgage. Your credit history, your credit account history is reported by 3 bureaus: Experian, Equifax, and TransUnion. The information is pulled by the credit company through their algorithms. What's really interesting about this and can be somewhat confusing is the algorithms, right? So all 3 bureaus have 13 different algorithms that they use for coming up with your credit score. And they use a specific subset of those algorithms for different credit reporting reasons. So for example, if you're applying for a credit card, they're going to use a certain chunk out of those 13. And it could be any one of those algorithms in that subsection. For mortgages, it's a subsection of 5 different algorithms. They're only using one. And things for like credit monitoring, like Credit Karma, for example, uses a different subset. So it's common for people to be a little bit confused when Credit Karma says their credit score is such, and then they go to apply for an auto loan and it's different, right? Or they go to apply for a mortgage or a credit card and it's different than what Credit Karma is saying. It's not that any of them are wrong, but they're because of the type of credit report or the credit scoring model that credit type requests, you can come up with different scores based on those different algorithms. So the lender is going to be looking at 2 different things here. They're going to be looking at the FICO score, which is the numerical representation of your past performance, right? So oftentimes you hear, well, you got to have a certain credit score of X to get a home loan or to get the car loan or whatever. And as you know, like applying for credit cards, the better that your credit score is, the better your terms are going to be on the credit card, right? They'll probably approve you for a higher limit and probably give you a little bit better interest rate. And it's very similar in all aspects of financing, mortgage included. The better your credit score, the better your lending terms are going to be, generally speaking. And then we're also looking at your debts, your monthly debts, which we discussed on the debt to income ratio. And we use that credit report to pull those debts. Let's talk about income. How do we use income on a mortgage? Well, income is really the key thing, right? We have to be able to determine how much mortgage you can afford. Like, what is your ability to repay this debt that you're going to take on? So your income must have a history, must have an industry history, not a job history. So what do we mean by that? Well, when we do a loan application, we're looking at the past 2 years. So we're looking at a 2-year history. Not only are we looking for stability in income, right? Because we want to see that it's stable. Maybe it's going up with pay raises and things over time, but we're also looking for the stability in that same industry. So if you're a nurse and you've been a nurse for 2+ years, then that's good because it shows us the industry history that is constant and steady, right? What would be a challenge to that would be you went from being a nurse in that example to selling cars within 2 years. Now you don't have the 2-year continuance or the 2-year history in the same industry, and that can present some challenges in getting a loan. So 2 years in the same industry is what they're looking for. There's some carve-outs and caveats for the VA loan in that though. It must be stable and likely to continue. So one of the things that we do during this process is what's called a verification of employment. So there's a couple times when this happens throughout the loan process. But there's a written form that the employer fills out, and then there's also a verbal check before the loan closes to ensure you're still there. One of the questions on this form is, are you likely to continue being employed by them? What is your status? Of course, if they said you're not likely to be employed, that would have an implication on your loan because no income coming forward. But that's what we're looking for on the income, and has to be documented, right? It has to have an existence, it has to have an amount, and that's usually verified through pay stubs. Assets. What are assets and why are they used? So assets are used for down payment, closing costs, and reserves. What that means is not all loan programs are treated equal. Some loan programs have greater down payment requirements than others. So your assets, your money in the bank, is what we're looking at to see if you have enough money for a down payment based on, maybe the loan amount that you're seeking. Closing costs. So closing costs are those third-party fees that are the transaction costs for doing a mortgage. Whether you're buying a home or whether you're refinancing an existing mortgage, there are other third parties that have to come into play to make the transaction happen. One easy example of that is the appraiser, right? That's someone who's third party, not related to the lender, not related to the real estate agents. They have to perform their function to determine a realistic value on the home that we can all use. So that's an example of a closing cost. And then reserves. What are reserves for? Well, certain loan programs will require that you have extra money beyond the down payment, beyond the closing costs, just in reserve. Think of this like, oh crap money. Like If you lost your job and your world went to heck in a handbasket, would you have some money stashed away to be able to cover the mortgage for a couple of months? That's what the reserves is for. And as you get more into real estate or investing into real estate, that reserve number can grow as your real estate portfolio grows. One good way to make sure you're building reserves is to leverage either your 401k at work, or if you're in the military, your TSP, your thrift savings plan. Automatically takes out of your account, your paycheck, and you won't really even notice it, but over time that's growing and building, and that example is something that can be used as a reserve. The money doesn't get touched. It's just there just in case everything went to heck and you had to get some money. It's there for you. So other things that we look at, bank accounts, IRA statements, could be like your E-Trade brokerage account, 401k, which we mentioned, mutual funds, all that type of stuff. Not every loan program requires assets though. We'll get into that, but they don't always require assets. And when required, we do request 2 months of statements, usually for bank accounts. Your IRAs, your 401ks, thrift savings plans, and things like that typically only provide quarterly statements. And in that case, we would request the most recent quarterly statement. But for bank accounts, we're looking at the last 2 months. And there's a few different reasons for that, which we'll get into. Debt to income, which we touched on a little bit earlier, refers to the relationship between your gross monthly income and your monthly obligations. So this is a key factor that we use to determine how much you can qualify for. So when we get your whole file put together, a lot of times we're really keying in on what this debt to income ratio number is. But basically, this is your income divided by the proposed housing payment and your debt, which we described from your credit report, the minimum required payments on all the things that pull up on your credit report. The loan to value is the amount of mortgage divided by the value of the home, or the amount that you owe on the home divided by the home's value. The lower the loan to value, the lower the bank's risk. So think about that for a minute. You know, if you have a home that you want to buy and the bank is willing to lend you money on it, well, the more skin in the game that you have, the lower the risk on the lender, right? Because the lender is always reviewing these loan files in a worst case scenario. They're always thinking, okay, if this client were to quit making their payments and the bank had to take over that home in a foreclosure, what position would they be in? If it's someone that leveraged more money, meaning they took out more loan and less down payment, that puts the bank in a riskier position, right? They stand to lose more money because in some instances, they may not be able to resell the home, and after their transaction costs and attorney fees and so forth, they may not be able to recoup enough money to break even in some instances, right? So the more money you have invested into the deal, the more skin in the game you have, oftentimes the bank is going to reward that because it's a lower risk to them. So they're going to reward that with the loan terms, probably better interest rates. They might be a little bit more flexible on some of the other things with reserves or debt to income ratios and so forth. Let's go over a home buying scenario. And this is a really good one that recently happened. We had a recent Air Force veteran, currently in the healthcare industry, wife, 4 children, and they're purchasing the following home. We're gonna walk through the numbers on this a little bit to give you an example. So single family home, it's 5 bedrooms, 3.5 baths, 2,500 square feet. It's on a lot that's 7,800 square feet, so good sized lot. And the asking price on this was $699,800. Here's how the offer came together. And this is in a hot seller's market. Total price came to $735,000. There was 4 offers received total. All of them were non-contingent. So what does that mean, non-contingent? That means that the person buying the house doesn't have another house to sell in order to make this transaction happen. So they can go in there, they don't have to wait for something to sell for this to go. There was an initial deposit, earnest money deposit of $1,000, and then $2,000 additional deposit was due once the appraisal report came in. Closing costs on average run around 2% of the purchase price. So we had about $14,000 and change in closing costs there, but we were able to negotiate that the seller kick in $10,000 as a credit or a concession to the buyer. So meaning the seller, once everything closes, they're gonna take 10 grand less than the 735 number and give that to the buyer to help them pay for their closing costs. So total, when we get to closing in this scenario, the client had to come up with $4,700 in cash on top of the deposit they made. So they made the $1,000 and the $2,000 deposit. Seller kicked in 10. So what was remaining at the end was $4,700. So that's what they had to come with at the close, which is about 30 days after they started in the whole deal. Let's take a look at some of the numbers on this. Just to give you an idea, the principal and interest on this was $3,001. Property taxes, $613. Property insurance was $100. So their total what we call PITI, principal, interest, taxes, and insurance, was $3,713. Now, this was at an interest rate of 2.75, and it was on a VA loan. But here's the beauty of it, right? You're buying real estate. So this thing is going to appreciate. So here's what we're looking at in year one, and this is using a conservative number. We're using a number of 6.77%, which has been kind of the norm lately. After year one, the value of the house is about $784,000. And if you look at how much they've paid in principal on the far right column, they've paid about $15,000 down on the mortgage. So they're growing in that equity, right? And you can see here in the middle columns how much of the payment is principal and interest. And this isn't the actual amortized payment. This is just the initial one to give you an example. But we're really just looking at the appreciation over time. Year two, 837, year three, 894, and so on. By the fifth year, this is $1 million piece of real estate. So this is a really, really good investment. After 5 years of that home appreciation with an initial mortgage that started at $735, remember, $75,000 of that $735 has been paid down. Now, if you take the $1 million value minus their current existing balance on their loan, they're looking at about $360,000 in gross profit if they were to sell it at year 5. That's a pretty good return for a zero down product. All right, so let's dig into the VA loan a little bit. I know that was a little bit of a teaser. Let's talk about the VA loan. So the VA loan is not provided by the VA, and I know this is sometimes surprising to people, but the VA isn't the one cutting the check. They're not the one reviewing the loan documents and doing the math on the income and all that stuff. That's not their role in this at all. Traditional banks and lenders are the ones that provide the money for VA loans. They're the ones that fund the loan. And what the VA's role in this whole thing is they guarantee the loan on behalf of the eligible veteran. The guarantee amount is 25%. So think of the VA kind of like an insurance company. Think of them kind of like State Farm for the bank. So they're basically saying, hey, Mr. Lender, we are going to guarantee this loan up to 25%. Meaning, if this veteran defaults on the loan and quits paying it, no questions asked, the VA is going to cut you a check, Mr. Bank, for 25% of that loan. And that puts the bank in a lower risk position, which is why we see VA loan terms better than some others. We'll get into that because they're already coming in as if you got some down payment. Prior to 2020, this eligible guarantee was up to the county loan limits. Nationwide, different counties had different limits, and they still do. But prior to 2020, you were only guaranteed 25% up to that limit. And if you went over the limit, you had to self-guarantee. So you had to come in with 25 cents for every dollar you went over. That changed in January of 2020. January of 2020, what happened is we had a new law that was passed in the summer before that, which was really designed, it was the Navy Blue Water Act, and it was designed to help Vietnam and Korea era veterans to receive some medical care and VA medical treatment for things that happened to them while they were in service. You know, a lot of them were exposed to different chemical agents. Agent Orange is, you know, popularly known one, but they weren't considered treatable by the VA per their rules and guidelines and everything else. So that group of veterans wasn't able to get any medical care from their time in service, which was really kind of a shame. So the Trump administration created this law and passed this law to take care of those veterans. But they understood that by introducing a whole new group of veterans into the VA healthcare system, that there was going to be a cost to manage that and take care of it. So what they did is they levered the VA loan in order to help. So what part of that, and we'll get into the rest of the details next, but part of what they did is they eliminated the county loan limit for VA loans. So now you can go even higher than what the county limit is, so long as you can qualify. So who qualifies for a VA loan? 90 days in active duty during wartime. So we have been technically by DoD standards in a time of war since the first Gulf War. We have been in a war state for a while. So 90 days of active duty service during wartime. This does not include basic training or your MOS or tech school after that. So you have to complete basic training, you gotta complete your schooling for your job, and then once you enter your unit and you're actually doing the work that you got trained for, that's when that 90-day clock starts. Now, if the DoD changes our designation to being in peacetime, then that 90-day time frame extends and becomes 181 days, where you're doing your job at your unit before you're eligible for the VA loan. A service member's spouse, like if the service member were to pass away or get killed in action, will inherit their VA eligibility, their VA entitlement, so long as they don't remarry. And for reserves and National Guard, you have to have 6 years in service without missing any of your drill dates. I mean, you can miss them as long as you make them up, but your points record is what they're really looking at to make sure you have that. Keep in mind, anybody in the Guard or Reserve, if you're thinking of getting out after your second enlistment at the end of the 6-year mark, nothing wrong with that. But a lot of times the commander or your unit leader is usually trying to be cool with you and might say, hey, you know what? Why don't you take the last day off? Don't come in. We love you. High five. Go have fun on the rest of your life. The thing that happens with that, and it's unintentional, is you don't complete the points record for 6 years. You're short by that one day, and you will miss your VA entitlement. So make sure, if you're in the Guard or the Reserves, that you complete your full obligation every single day so you can receive this amazing benefit, which is the VA home loan. So who can use it? A veteran can use it. Active duty counts as well, as long as you have the days in. A veteran and a spouse. So if you're married, you can use it with your spouse and their income can be included. 2 vets or 2 active duty people can buy a house together. So it could be 2 guys in the same unit. I've seen it a lot with pilots. They're not at their house a ton, but they want to get involved in real estate. So a couple of them will partner up and they'll just buy a house together. And it's a great investment. They know it for years down the road. A veteran and a non-veteran can buy together. It changes some of the rules on the VA loan, which we'll talk about, or a widowed spouse. So I mentioned before, if they were killed in action, or if the veteran were to pass away from service-related issues. So it can't just be they passed away from old age. It has to be that was really, really traceable and directly related to their time in service is the reason for their passing. Then the spouse will inherit their VA eligibility until they remarry. And as soon as they remarry, it goes away. So VA loan limits, as I mentioned earlier, prior to 2020, you could get 100% financing up to the conforming loan limit in that particular county. So in 2020, the San Diego loan limit was $701,500. Orange County was a little bit higher. Riverside County was at $510,400. And what's interesting about that is in the San Diego area specifically, you have Camp Pendleton, which is a humongous Marine Corps base, and it basically touches all 3 of those counties. So you'll have a lot of service members that maybe can't afford to live in Orange County, and maybe San Diego County is still out of reach, but Riverside County is a county where like Temecula, Murrieta, and wine country and stuff is, where the homes are less expensive. You get a little more bang for your buck. But in the past, we had that loan limit at $510,400, and oftentimes, a decent family home was starting higher than that, which meant before 2020, you'd have to come in with some down payment. And that precluded a lot of active duty Marines and Navy fellows in this area from being able to buy because they didn't have that down payment piece. Well, that's all changed. January 1, 2020, HR 299, the Blue Water Navy Vietnam Veterans Act is the full name, meaning if you have full entitlement, which is a key word there, then there's no VA loan limit. You got to qualify for it. But for example, we help a lot of people out with high dollar, $1 million+ home purchases with 0 down, which before was unattainable with 0 down payment, and now it's very possible. Even if I'm eligible for the VA loan, is the VA loan the best option? Generally speaking, yes. It's going to be really hard to prove in scenarios where the VA loan is not the better financing tool. But this is kind of the ranking of level of importance. The VA loan is probably the most important or the most valuable loan product out there. Conventional would be next. FHA would be after that. And then renting, of course, is at the bottom of that totem pole or that list. So what we're going to talk about here is VA versus the conventional. Interest rates are one of the big things, right? Everyone's focused on interest rate. Well, interest rates differ between VA loans and conventional. The difference between them is usually anywhere from 1/4 of a point to 1/2 a point. And the VA loan is less expensive or lower in rate than conventional loans. The reason behind that, as we mentioned earlier, is risk, right? The VA is guaranteeing the lender 25% of that loan, no questions asked. Well, you can get into conventional loans for less than 25% down. So unless you had a 25% down conventional loan, you're not at the same risk level to the bank as the VA loan. So the VA loan's lower risk, they're gonna get better financing terms. The other thing that's interesting is because conventional loans present a little more risk to the bank, they are a little more sensitive to credit score. So your credit score has a higher weight determination on your interest rate than a VA loan. Even though interest rates or credit score is very important for both, has a little more impact on conventional loans. Credit, as we talked about, so VA clients are less negatively impacted by credit imperfections than conventional loans, meaning you might have a little bit lower score. If you're going with a VA loan, you're potentially going to get the best rates out there. If you were to move over to conventional loan, it's going to be much worse rate. And even with a higher rate on conventional, you still wouldn't have as great of a rate on the VA loan with someone with a lower score. So income. The VA allows up to, and I've even surpassed, a 60% debt to income ratio. Conventional loans typically top out at about 45%. If the file is really strong, meaning very high credit scores and a lot of assets, then oftentimes we can push that to about 49%, but 45% is about the average. So this allows for more flexibility. Even if it's not utilized, it presents a lower risk picture and gives you more purchasing power. So assets, down payment, and loan to value, all that comes into play when making these determinations. So conventional loans, they will allow for as little as 3%. So for first-time home buyers with a conventional loan, you can get into them for as little as 3% down, which is really great because so many people think you got to save up for 20%, so they don't even look at buying a house. Not true at all. You can get in there for a pretty low down payment. But whenever you have less than 20% down payment on a conventional loan, you incur what's called mortgage insurance. The banks require it. It's not optional, and it is not a benefit to you as the homeowner. It's a benefit to the bank because it helps to offset the risk, right? So you go back to the conversation about possibly the bank taking over in a foreclosure situation if you quit making your payments. Well, they want to mitigate that risk because if you only put 3% down and they got to take over your loan and maybe the house isn't in good repair, they got to repair it, they got to put it on the market and sell it, and they got attorney's fees and realtor's fees. If it was only 3% down, the bank is going to be in a huge loss most likely on that. And that's not a bank's model, right? They're there for profit. They're there to make money. So the PMI, the private mortgage insurance, is an insurance policy that the bank requires you to keep and carry until you've hit or eclipsed that 20% equity mark. So it's an additional monthly cost. It's not something that you really go out on the open market and shop for. We help you secure that with the least expensive one as we can find. But that's what it is if you have less than 20% down. Because the VA loan guarantees 25% of the loan, even on no down payment, there's no mortgage insurance required because they're guaranteeing 25%. So in that foreclosure example, again, if the bank had to take over, the VA is going to be like, boom, here's a check, 25%, no questions asked. Have a nice day. So in summary, the VA loan is less restrictive with their credit requirements. They have lower interest rates. There's no down payment required. There's no monthly mortgage insurance required. And they're more flexible on the debt to income ratios than the conventional loan, meaning you have greater purchase potential on the VA loan than you will. So in most cases, the VA loan is going to be better for those that are eligible for the VA loan. It's going to be better than the conventional loan for all of those reasons. Let's talk about another scenario. Another home buyer scenario. This is actually number 3. Save number 2 for later because it's my favorite and it's really cool. But this example, we've got a Coast Guard first class petty officer. He was buying off Treasure Island Coast Guard Station with his wife and his daughter. They bought a condo in Pleasant Hills, California, 2-bedroom, 2.5 bath place. Really, really awesome location. Great for them for commuting and all the stuff surrounding it. It's only about 1,250 square feet, so it's not a huge place. Asking price was $589 on that. The HOA, the monthly house home association fee, was $695. And the condo complex was VA approved, and that's important when looking at condos. It has to be approved by the VA. We can help get it approved if it's not, but if we can't get it approved and it's not approved, it's not an option for a VA loan. Let's take a look. What did the deal unfold at? The total price of this house ended up being $590,000. There was an offer that was accepted prior to this one. They were in escrow and it fell out. And so we were able to come in and help them secure this home. Clients came in with a $10,000 earnest money deposit. They came in very strong. At this purchase price, at this time in the market, in this location, oftentimes offers are given more favor if you come in stronger with your deposit money. It's not always required, but in this particular time of the market and everything, that's what it took to get this house under contract for this Coast Guard member. So closing costs were about 2% on this, so $11,800 in closing costs. He already had 10 grand he put as a deposit. So what was remaining when he closed escrow at the end of this? He only had to bring another $1,800 because he already put 10 grand up ahead of time. So let's take a look at what the numbers break down to be. So his principal and interest payment was $2,409, taxes $575, HOA fee $695. Insurance was less expensive because it's in a condo. The condo HOA does cover some insurance costs there for the exterior. So his total all-in monthly housing obligation is $3,762. So let's look at the appreciation. Like, what kind of an asset is this going to be for this guy? At the end of year one, he's paid down his home almost $13,000, $12,680. So he's, been making his payments on time. He's grown his equity a little bit. By year two, that home's going to be worth around $672 at our current appreciation rate in that market of about 6.77%. So you can see as you follow this down, the end of year five, it's worth a little over $800,000, $819,000. So if they were to decide to sell at the end of the 5 years, they would have paid the mortgage down to about $526,000, and the home was worth about $819,000. They're looking at a gross profit of about $292,000. So they made $41,700, or they spent $41,700 in HOA fees over the 5 years also, just to note. All right, so let's talk about an approval. Here's a sample approval that we're gonna go over. The pre-approval example, basically what we're gonna do is give you some step-by-step examples here of a Marine Corps sergeant who's interested in buying a house using a VA loan, and kind of put all this stuff we talked about into practical use. So here's the data we're gonna use. Here's the example data. Active duty Marine with dependents, right? That's important for the BAH number that we get to use. 6 years time in service. He's pay grade E5, which is a sergeant in the Marine Corps, and he's got a $350 a month car payment. He's got another $100 a month in his minimum only payments on his credit cards. His income, 6-year Marine sergeant, is $3,454 a month, so that's his rank pay. His BAH with dependents is $2,592 a month, and his BAS, $369. So we total all that up. His total income for us to use on the mortgage application, $6,215 a month. Now his total debt that he currently has is $450 between the car payment and adding up all his credit card payments. If his debt has to be less than 60% of the total monthly income, how do we get there? How do we solve for that? We got to solve for X, right? Which is how much housing payment can he have? Here's what we're going to do. We're going to deduct that $450 a month out of his $6,125 and multiply by 60 to see what we've got left over. So we've got $3,729 available for total housing payment. So they would qualify for a maximum monthly payment of $3,279. And how we did that, we took the 60% of $6,215 minus their $450 in debt. And that's what brought us to that number. So their max purchase price, depending on interest rates at the time, this family would qualify for a home purchase in the amount of about $550,000. Obviously, interest rates up and down can fluctuate that a tad. So this would include principal and interest, which is the mortgage payment itself. So the mortgage payment itself is $2,608 in this example. Property taxes of $521 a month, and insurance of $80 a month. So it's going to include all of that. We call that PITI, principal, interest, taxes, and insurance. That's the full housing payment. And that brings them up to the total they qualify for. And we figured possibly they're going to buy in a neighborhood where there's an HOA with $70, which in an average neighborhood, $70 is fairly close. That gets them to $3,279 a month. Now, if they found a home that did not have an HOA, we have another $70 available to us in this payment that we could increase their purchase price some. What if you don't know how much home you want to buy? You don't have any idea what the prices are or what you need to target, but you're trying to figure out how much income you need to qualify. So how do we kind of reverse engineer this? How can we solve for this problem? We use the same information that we used before. So you're going to take your gross monthly income, add that together, okay, times 0.6 or 60%, and then deduct or subtract your credit obligations. Maybe an auto loan, credit cards, if you have any student loans, deduct it from there, and that will give you what your total monthly payment can be. And that's how we kind of reverse engineer. So let's look at home buyer scenario. This is actually number 2, but this is my favorite one because now we're talking about how we can really leverage the power of this VA loan, which is so cool. But with this particular one, we have an Army Staff Sergeant. He's got recruiting duty in Benicia, California, and his wife is also in the Army. But they're up near Edwards Air Force Base is where his recruiting duty is. He has the investor bug and he wants to get into real estate investing. He wants to set up his family for the future and wants to buy a multi-unit home. 4 units is the maximum that you can finance with residential financing, whether that's a VA loan, conventional loans, FHA loans, etc. 4 units is the total max. He wants to get into this. I personally believe this is the best way to leverage your VA loan, which is to buy multifamily. I think it sets you up for the future in the best way possible. So he found this 4-unit multifamily home, totally fell in love with it. And kind of the story behind this house is when he found it, he wasn't pre-approved yet, and the house quickly went into escrow. Again, super hot market, and he missed out on the opportunity. That kind of lit a fire for him to get really moving forward with the pre-approval process. So we got all his documents, we did all the debt to income ratio calculations, all that stuff. We got him all dialed in, ready to go, and he got to go out there and start hunting. And as he started looking, he noticed this particular home he had his eye on came back on the market. The first buyer fell out. They fell out of escrow, and they weren't able to complete the purchase for whatever reason. So it came back on the market. He wanted to swoop in and get it. So here's what that place looks like. One of the units is 2 bedrooms, 2 baths, and it rents for $22.95 a month. The other unit is a 1 bedroom, 1 bath, so smaller unit, rental rate of about $19.55. And then there is a studio that rents out for $12.25. And then the 4th unit is the one which the Army member and his wife are going to occupy. So the total square footage on the home is 1,910 feet on a 6,000 square foot lot. The asking price on this home was $889,000. Now that's important for this next slide. They came in with an offer at $900,000. So notice they came in over the asking price, which you saw in a previous example, because the other offers had fallen through when they were trying to get an escrow because of financing issues, appraisals, and different inspections and things like that. So he came in and said, hey, here's $900,000 and I'll put a $3,500 deposit up front. But here's what I want in return. So in return, he asked for $18,000 in closing cost concession from the seller. So they went from $889 up to $900 in price, but then said, give me 18 grand back. So we went up a little higher in cost, and that's, when people are asking me all the time, how do I finance in my closing costs? That's how you quote unquote finance the closing costs. You go a little higher than asking, then have the seller credit you back, and that way you're essentially financing the costs in there. There was $18,000 in closing costs credited back to the buyer. His total seller concessions, he ended up, also being able to recoup the deposits that the renters had put in place, which was about $10,000. So he's got almost $30,000 there to work with. So really his net at the end of this, he actually received a check back for $12,000 because he got 20 grand in seller concessions, only 18 were the closing costs, and then he had 10 in landlord deposits. What we were able to do with him is we actually were able to help buy down his interest rate a little bit lower, which is going to improve his cash flow. So here's the numbers. Let's check this out. These numbers are great. So principal and interest payment, we got his rate down to 2.375 on a 4-unit property, 0 down payment. That is incredible. Mortgage payment on that is $3,498. Property taxes $564. Insurance $229 for a total of $4,291. That's his total monthly obligation. Year 1, that place is going to appreciate to about $936,000. Now, multifamily homes don't appreciate at quite the same rate, so we used a more conservative number here of 4% in appreciation. But you'll see in the far right column, he's paid down almost $21,000 on that note. And year 2, $973, and we fast forward all the way to year 5, the value of that place is about $1,094,000, but he's paid down, look at the far right column, almost $110,000, $109,247. So at the end of year 5, if he were to decide to sell this place, what he would be able to do is sell that place at $1,094,000. His loan balance now is only $790,000 and change. So he walks away with a little over $300,000 in gross profit. And here's the kicker. In 5 years, he has also generated $71,040 in profit from the rent being generated on those other 3 units that he's not living in. So essentially, those renters pay for his mortgage every month, and him and his wife are able to save their BAH and just stick it in the bank, save, live off their E5 pay their bills, go out to dinner, enjoy life off that pay because their mortgage is covered, and save all that money. So now when the time comes that maybe they have a child, or they just need to move and get a bigger place, or they get new orders somewhere else, they've got this big $1 million property in California that they're gonna move out of, and they wanna keep that at the super low rate because the cash flow is so good, but now they're gonna rent out that extra unit that he was living in. That's gonna more than cover the mortgage, but they've been saving all these years, that BAH. Now they have plenty of money for reserves in case something were to happen with a renter or the home or whatever. And they also have money for down payment to go buy the next house. And they'll use a different loan, probably a conventional loan on the next home. All right, so let's talk about the true and the false, the myths about the VA loan. And there's lots of them, but we're gonna cover some of the top ones here. First one we hear a lot is VA loans are only for first-time home buyers. That is false. The VA loan doesn't have any restrictions that require it to be used for your first-time purchase. The only requirement that the VA loan does have, which is not movable, is that the VA loan is only available to be used to purchase your primary residence. You gotta live there to buy it. You can't use it to go buy a rental property across town or a vacation home at the lake. It's gotta be where you're gonna live. I can have 2 home loans at once? True. You can actually have 2 VA home loans going at one time. Requires a little bit of math, but we can do it. I have many clients that have 2 VA home loans. I even have one client that has 3 active VA home loans. It does take some math, but we can help you figure that out. The VA entitlement remains in one. So basically, we're just looking at the new home. It has to be your primary residence. So you're moving away from one and moving to another. Change of duty station is a perfect example of a reason why you would do that. Buy a home in the new market where you're going to be in, and we can do the entitlement math and the calculations for you to determine how much VA loan you can get at the next place with 0 down. You can always go above that and put some down payment, but we'll do that math for you and show you what it's going to look like. I can buy a 4-plex using the VA home loan? True. We just talked about that. One of my favorite scenarios and favorite things to talk about is using the multifamily property as the property type to purchase with the VA loan. You got to live in one of the units, but it's an awesome investment. 1 to 4 units are considered residential. So remember I said it's only up to 4. Once you hit 5 or more, it's considered commercial. And so the VA loan is out at that point. But as long as one of them is occupied by you, then you're good to go. It's considered owner occupied and it's eligible. All right, my non-veteran spouse's income can be used to qualify for the home that we want to buy. That's true. If you're married, you and your spouse are both working, we can include both incomes to help you qualify. A spouse's income can be used as long as it's stable and from an acceptable source, just like any other loan. There are certain circumstances where the VA loan may not be the best loan option. True. When planning any job, you want to first figure out the goal and apply the right tools. There have been some scenarios where the VA loan is not the right financing method. It might be the home isn't going to be totally a primary residence, might be more of an investment, might be more of a second home. Perhaps we have to use a different loan type because of the way that your income comes in. You may not be in the military anymore, might have a business or something else, and we've got to use a different loan type to make it work. A couple of examples, like we went over, buying a smaller temporary home and you plan on buying a more expensive home later. Or if you were planning on putting 20% down, you got the cash, maybe you sold another house, you just want to chunk it down on the next one to reduce your payment, absolutely can. And oftentimes, a conventional loan can be better, especially if you're required to pay the VA funding fee and if you're not exempted from it. In all cases, education and planning is what's going to help you make the best decision. So that's why you need to get in touch with myself, a mortgage advisor who understands not only the VA loan well, but the other loan programs as well to help you figure out what's going to be the best tool to move forward in your home purchase. Talk about that VA funding fee that I just mentioned. The VA funding fee, this is the way the VA is funded, is through these funding fees. So let's talk about that a little bit. If you're active duty, reserves, or National Guard, and depending on your down payment or the usage of the VA loan, this percentage can vary. But if you have no down payment and you're active duty, your first time use is going to be 2.3%, meaning it's the first time you've ever used the VA loan. If it's your subsequent use of the VA loan, then that number jumps to 3.6. This is the only closing cost that can actually be slapped on top of your loan and financed. So remember we talked about closing costs a little bit earlier, those other third-party fees. The appraiser was the example that we used. There are others that are included in that, which totals that number that you saw in some of those examples, which was around 2% of the purchase price. This number was not included in that 2%. This number is actually financed on top. If you have an exemption from the VA funding fee, then obviously it goes away. If you have some down payment, now, if you have a 5% down payment, you can reduce that fee. So first time use cuts it down to 1.65, and even for your subsequent use. So it's great if you're buying like a second home, like you lived in a home for a while, decided to sell it, and you do have some money for down payment. Maybe you don't want to use all of your money, but you want to use some of it. Use 5%. That knocks this thing almost in half, which is a great savings. And if you have 10% or more, it reduces it even further to 1.4%. Typically, that's always rolled into the loan. I've had some people who would rather just pay it cash, and that is an option. You can pay for it cash. How do you get it waived? If you have a service-connected disability, then it's waived forever, for life. So you can buy and sell homes, and you'll never have to pay that funding fee. The other thing, as a result of that new Navy Blue Water Vietnam Veterans Act that was passed is they also incorporated in there if you've been awarded a Purple Heart. You could still be active duty and have a Purple Heart, and now you're exempted from that funding fee. VA loans do not require any kind of down payment, so I don't need any cash at all to purchase a home. I hear this and run into this scenario a lot. It's a common misconception. The answer is maybe. You may not need some money, you might. And it really depends on the scenario and the way it's negotiated, and the market has a lot to do with that too. Recently, we've been in a hot seller's market, meaning the sellers have more of the upper hand in the negotiation than the buyer does. Now that turns, markets ebb and flow. Just prior to that, we were in more of a buyer's market. So the buyers had a little bit more of the leverage in the negotiation, and they were able to dictate some of the terms a little better. So when we say maybe, closing costs always exist. So if you ever talk to somebody who says, I didn't have any closing costs with my VA loan, it's false. They had closing costs. They may not have paid for them, but the closing costs did exist. They exist on every mortgage you will ever do, whether it's a purchase or a refinance. So it just depends on who pays it, right? And how they pay it. So in a purchase example, which we showed you, even on that multifamily example, they went a little higher in price and had the seller give them a concession which covered those closing costs. So that would be an example where someone might say, hey, I never had any closing costs. Well, the closing costs existed. The seller just paid for them for you. All right, so let's talk about closing costs a little bit. There are two separate categories of closing costs. There's the true, what we call non-recurring closing costs, and then the prepaid expenses. So the non-recurring closing costs, those ones are the actual costs. The appraiser is the example that I keep using. It's a fee that he charges for his service. A title company is another one. An escrow company is another. Your insurance company and the credit reporting agency and stuff like that. All of them have the fee for their service, which is paid. So there are three ways you can pay the closing costs. You can pay them all out of your assets, right? You got them in your checking account, your savings account. You go to closing, write a check. The lender can pay them. So we can pay them for you through a rebate. And how a rebate works is, let's say the lowest interest rate that you qualify for without buying the rate down, let's say that rate today, as an example, is 3%. But you want the lender to pay for your closing costs, or a big chunk of them. Well, now what we're gonna have to look at is a little bit higher rate, and then a rebate starts to come in. And the higher your rate goes, the more rebate up to a certain point. And so we're able to lender credit or pay for the closing costs for you, depending on the rate and the multiplier of that. So there is a way to kind of use the bank's money to pay for your closing costs. And the last option, which we discussed, is the seller can pay for them as part of the negotiation. So what is the purchase process? As we get this thing close to wrapping up here, what is this process? What does it look like? And how do you navigate it? So the very first step you need to do is you need to get pre-approved for your home loan. I am telling you, if you call some places that are online that are big name insurance companies or the popular military affiliated bank, they don't do a proper pre-approval. They're not going to request all the paperwork and documentation from you, and this will cause you issues down the road. So you need to get properly pre-approved with your mortgage advisor. Come to me. We're going to look at all of your income, your assets, your credit. We're going to go through all of it, build a great scenario, and give you a good mortgage plan and help set you up for the future. We'll also run your file through underwriting. So we know when we give you that letter that you're for sure going to get your loan. When you skip those steps, like supplying the paperwork, which some of those big companies do, they don't make you provide all that. It's a quick phone call and here's your pre-approval letter. You're not approved. And the real estate agents and the people in the marketplace, they know that, and it's going to set you up for more of a challenge than a success. The next thing after you get pre-approved is the realtor goes with you and shows you homes that meet your criteria. So you'll have a great sit down with your realtor. And this is really the fun part of this whole process, which is going to look at the houses. This is the cool, exciting part. So your realtor and you, after you're pre-approved and they know what your buying limitations are, they will talk to you about what you're comfortable with and what the requirements are in the home that you like and location. So you're gonna talk about bedrooms and bathrooms, and do you need a garage or not? Do you need a big yard or no yard? Or do you want to be on the south side of town or the east side of town? All that type of stuff. What's your commute gonna look like? What are the school district ratings? All those things. Then your realtor is gonna be the one that helps you craft and write and submit the offer and help you with the negotiation terms. And really, a great agent is gonna be on the phone with the other agent selling the home, helping to sell why they should take your offer, right? And more than just clicking send on an email. They're gonna make that extra effort. So question, should you start your process by finding the home first or by getting approved for the home first? You should absolutely get pre-approved first before you find the home. Because if you find the perfect home online, you may not qualify for it. And with as hot as the market is right now, you might find that perfect home. And by the time you even pick up the phone to talk to somebody about being pre-approved, it's sold and it goes quickly. So it's better to be prepared and pre-approved prior to getting excited and finding the home. Who pays the buyer's realtor? This is a really good question, right? You're going to get a real estate agent to represent you and help you through this whole process. How do they get paid? Well, they get paid by the seller. So their fee is already predetermined and negotiated when the seller finds their realtor to sell the house, and they come up with all that piece of the terms. So you actually don't pay anything to your real estate agent that's helping you, representing you on the buying side. So it's awesome. You should always, always, always have a real estate agent representing you when you're buying a house. So what happens next? Well, the contract gets accepted by the seller. You guys agreed on terms, and there might be some negotiating back and forth prior to that. But once the offer has been accepted, we are in escrow, or escrow is opened, and that's the term. So the reason that's the term, and in most states we use an escrow company. There are some states like North Carolina, for example, that it's an attorney state and you use a real estate attorney. But in a lot of states like California, for example, an escrow company is the third party that facilitates the closing. So they facilitate the exchange of money between buyer and seller. So we're going to open escrow. And when you saw in those examples that people put their deposit down, they're actually putting the deposit with the escrow company or with that real estate attorney. They're putting it in their trust account. It just sits there, no one touches it. And basically that earnest money deposit is your good faith deposit, saying, I'm putting my money where my mouth is. I plan on completing this purchase per all the terms in this contract. And if for any reason I cancel, and it's not something for a reason that's contained within this contract, then you get to keep the deposit. That's what the deposit means. But that's very, very, very rare instance where that happens. So that earnest money deposit sits with the escrow company until you get closed, and then those monies are applied to whatever is due from you at the end. But once the offer has been accepted, we've opened escrow, that's when we, the lender, really shift into gear and get working on this loan. So we're gonna start processing that loan. We're gonna get it really spit shined and polished so we can get it over to the underwriter, and we're gonna order your appraisal. Your agent, the buyer's realtor, is gonna order the inspection. So if there's a pest inspection, there'll be a home inspection. There could be other things. Maybe there's a sewer there, a septic tank there. Maybe there is a well. So any of those kinds of things, they'll order inspections. Maybe it has a pool and you want to get a pool inspector out there to make sure the pool and the equipment's in good shape. That could happen too. But that's when you begin kind of that whole due diligence phase of inspecting the home, making sure that you're not going to get any surprises that you weren't expecting when you close escrow and own it. So what is the role of the escrow company? Some states, like I mentioned, use a closing attorney, but like we mentioned, they're the third-party intermediary. They handle the exchange of money between buyers and sellers, and they actually facilitate the closing and signing of those final documents. What's the difference between a home inspection and an appraisal inspection? Really good question. So the home inspection is something that is not required for any mortgage. The appraisal is always required. The home inspection is not. However, I would highly, highly advocate for getting a home inspection. The home inspectors are licensed, certified people. A lot of them have construction type backgrounds, and they go out to the home and they look at every nook and cranny of this place. They look in the crawl space, they look in the attic, they check under the sink, look for leaks, they test the sockets in the wall to make sure they're putting power, they make sure the furnace turns on or the air conditioning, all those types of things. They're gonna be out of that house for a few hours, and they put together a great comprehensive report of kind of the good, bad, and the ugly, and provide that report to you. So that report has a lot of value because not only could it mean renegotiating the deal if something significant was found, but also it just gives you a great understanding of what you're getting when you buy this house. Is it in good repair? Is everything pretty easy with a screwdriver and a hammer? You can fix it in a weekend? Quite possibly, right? For a home that's in good shape. So these are really good, but the appraisal is there to help determine if the value of the home that you and the seller agreed to exchange it for is supported by the market. That can be a little confusing because everyone thinks that the appraisal is a report to show what is the top worth of the home. And that's not entirely true in a purchase transaction. You have two parties, buyer and seller, who agree to a price on this asset. The appraiser's job is to ensure that the market supports that agreed upon price. So it's going to be pretty rare that you have a home that, say, you agreed to pay $500,000 on, that an appraiser is going to come back and go, hey, this place is worth $565,000. They're not going to do that. They're going to come in and go, $500,000, this is supported by other sales in the neighborhood of like homes, and here's a report that explains how I came to that conclusion that it's supported. Once your loan has been approved, the final loan documents will come out and you'll sign with either a notary, a real estate attorney, or the escrow officer, any one of those three, depending on the state and how it's handled there. The buyer's realtor and you will go conduct a final walk through the home. So right before you close, just gonna make sure that, you know, they left the things they're supposed to leave and they didn't kick any extra holes in the wall, but they left the home the way that it's intended to be left to you for this transition. And then the loan funds, we wire the money to the escrow company. They take the money that's due to the seller, they pay the seller, and the deed of trust is then taken to the county recorder's office and recorded. And when that happens, that is when you officially are the owner of that home. And then your real estate agent and you will get together, you'll get the keys, and you have your new home. So to recap what we covered today, we talked about the basics of home loans, kind of lending 101. We went into what the VA home loan is. We went over some different sample scenarios, some pretty cool ones. VA loan, frequently asked questions, some true and false stuff, and then the purchase process. So step one, arm yourself with the information, develop a personalized plan, execute that plan. If you have any questions, my team and I are here to help you with this process. We're experts at the VA loan, we're experts at lending, and we're here to serve you. If you have questions, you can email me at team@valoanguy.us. We'd be happy to answer any questions you might have. Thanks so much for checking out a little bit about the VA loan.